Hey guys, Beautiful Yields here. So time for the weekly portfolio update on how all of my positions are doing on the various platforms that I am on. So first things first, we're going to look at the heat map, obviously, of the general market for the last week, which you can see here. We have a lot of growth in a lot of different areas, mostly green. Obviously, there's some things here like FI, whatever that is. What is that actually? Yeah, I don't know what that is still. And anyways, there's a few areas, consumer staples, maybe not so much, as well as um, what are the other ones here? Yeah, I mean, just the consumer staples, not doing too hot, I guess. That's the only sector that I can really see. General, not green. But the technology, the consumer discretionary, consumer electronics, or, all of these sectors are doing very good, which is very good. For a lot of people's pockets. Now, obviously, the week before that was pretty rough. And if we look at a month view, we are still down very, very much, right? So, but obviously, 1 week at a time, as I always say. So I can't complain there. Yeah. So let's see here. I want to go into my Webull account first. Unfortunately, I lost more money here. You can see. Uh, I'm obviously starting to regret this now, but as I always say, this is something that we've kind of committed to, and I feel like if I take it out now, it's only going to get, you right in stone, so to speak. At the end of the day, if I lose another $260 on this portfolio, I'm not going to be, super upset. I'm already upset, but it is what it is. I still think we have some time before um, MSTR kind of hits the truck. Obviously, Bitcoin is on a ride a little bit in the last month, up to 94K, and MSTR is doing their MSTR stuff as well. So last week, a 13% increase as well as last month here. Now, obviously, the problem with this being a leverage fund is the fact that it's a leverage fund, and there's something called volatility decay, and also uh, basically think about this, right? If I go down 5%, it's not just a simple equation as okay, yeah, I need 5% to go up because it's percentage based. It's not an absolute value. It's not like going down $10 and going back up $10, right? So you need quite a bit more power to go back up. Now, the problem with that is with volatile funds on an inverse fund like this, it's going to really bite you in the butt, right? That's why inverse funds as a whole are pretty short term, and obviously this is why, right? So yeah, I don't know, man. To think a month ago we were at $857 was pretty crazy. And at one point we actually, I think, up on our investment uh, by almost $100. So that was February 27th. If only I sold there, right? Obviously, that's what I'm going to keep telling myself. But yeah, can't kick my butt like even more over that. So moving on to M1 Finance, we got a dividend this week for $45.84. I also forgot to go over that we got a dividend from a realty as well as a security lend interest. So those were from the 15th. Not that that's, an insane amount of money. It's 24 cents, but or 22 cents, but it is what it is. Obviously, it still helps. It's still money in our pocket. So moving on to the portfolio, currently sitting at $13,079, which is pretty decent. As far as the last week, according to here, we're up about 4%. And you can see all of the different portfolio thingies here. QTOL is up about 3%, where TQQQ obviously is the main driver of that. And we still have not had a chance to rebalance because there's just how things are going. Our What I might do is I might hit the rebalance button. And what that will actually do is basically sell off a lot of these things. Like, first of all, it's going to sell off a lot of BTOL, move it into probably CQQQ, but also make this so it's 25%, as well as this is going to come down to 25%, as well as our balanced growth portfolio is going to jump up, obviously. But I'm still trying to make up my mind because obviously with YMAX specifically, we are down, I think, quite a bit. So if I go all, we're down about 16%. Yeah, and that includes the dividends earned from this. So, I don't know if these two are in combination. So if they're not, then, well, yeah, look here. So still, I don't know. So if these aren't, then obviously we're down only $600. Well, I say it's only $600, but that's still a lot. And yeah, I don't know. We have about 335 shares. We put in almost 6,000 to this, but our current value is about 4,000. Anyways, last week, 5.5%. So that's another thing. Like, we can keep waiting for this to go up, but obviously it can do the same thing as MSTZ. Now, obviously it's not inverse fund, but what I'm saying is we could basically shift like a lot of money from these two portfolios into our balanced growth portfolio to be a little bit more safe. I'm not so much worried about QTAL, but with yield max funds, they're not really known for being able to come back after a big hit, and we're seeing that evident here with YMAX. But moving on to the growth portfolio, we can see here if I go here, semiconductors up about 14%. The main driver of that being AVGO, which is actually kind of surprising. The other ones are about equal. Technology up about 7%, almost 8% actually. Largest driver of that is Google, and that makes sense with their earnings, I believe. That was recent. And financials, largest driver being Morgan Stanley. On the opposite side, we're down, like I said, on consumer staples. We saw that on the chart. Main one being Pepsi. We're down on energy. Main one being probably ENPH. This is a very volatile fund, to be honest. So this probably will be up 12% next week. Who knows? And real estate, largest one being AMT. So yeah, I mean, overall, obviously not bad. We're up at the end of the day, which I'm very happy about. So yeah, I mean, I can't really complain. Last but not least, this is the new one as of last week. I put in money. It took a little bit to get actually settled in. So my first trade was on Tuesday, but I'm very happy to announce that we're up already 10% almost. So 9.5%. And with the two strategies I picked, you can see here, one of them in the blue is this lower one. This is one I got from a Discord. It actually looked pretty promising, but I really should have looked more into it because, and this is what I was kind of hinting at in my other video. If you take a look at this strategy, let's see, I think I can press edit, and I think there's a button to, yeah, do that all. I think. Yeah, so I want you guys to take a look here, right? So you can see each one of these is going to be a different branch, essentially, and so there's a bunch of logic here, but watch. So obviously you can see I'm scrolling for a long time. Now, what this is indicative of, I'm sure a lot of these are just kind of the same package, but what this is indicative of is overfitting. Now, I know this person actually on the Discord has done a lot of statistical background on this, so that's why it was kind of interesting. But I also think that it's a case of this person looking at their they're basically return, right? So in machine learning and really any kind of uh, thing where you're doing like something like linear regression, you really should separate your validation data from your test data, which I think they did. But the problem is what he did is he used his test data to validate his strategy. Um, what that kind of does is if, let's say, he does his training, right? Basically, he tests his strategy on his validation data. It says, okay, it's going to do this well, but then he goes and tests it on the test data and says, okay, it didn't do that well. Now he goes back to um, his strategy, tweaks a few things, retests it, sees that the test data is now performing better than it previously was. Now he sticks with that strategy. What he's now doing is kind of mixing his test and validation data to where he is trying to validate against the test data and not so much the validation data. And obviously that's where the overfitting comes in. And you can also see that I don't think this has it, but you can just see that as well as he has way too many logic branches, right? I just show that off, and it doesn't matter, right? Like that's super messy too. Put simply, um, typically the more simple the strategy, the better it is, right? And that doesn't just mean obviously, oh, if this, then buy that, otherwise sell, or something like that. It doesn't have to be that simple, but when we're talking about several hundred different branches that this can take, it's going to get really complicated. And as well as something else I was hinting at the end of last video, with Composer.trade, unfortunately, it's not the best platform in the sense of trading windows, right? Similar to M1 Finance, there's actually only a limited number of trade windows. So in M1 Finance, you have a morning trade window and a afternoon trade window just before close. On Composer.trade, you only have a afternoon trade window, and it's 10 minutes before the market closes. So you have a 10-minute span where your strategy might actually be completely different from if you had, if you had executed, let's say, a minute before the market closes. So another thing is the test data that we perform on with our backtests is using closed data. So it is actually not the same data that we're going to be using in the live investment simulation, not even simulation, but like the live trading. Um, so it kind of defeats the purpose sometimes. Now, obviously, there's a lot of other stuff that goes into that. Some strategies are going to be a little bit better fit for this case because they're less volatile. And so, if you have a less volatile strategy, or maybe not even the tickers themselves, but also the indicators that you're using, um, such as an RSI or something like that, the less super tuned logic you have there, the better in most cases. Obviously, you still want to try to maximize in your backsteps as best as you can, but also you got to be very careful of overfitting, as well as obviously backtests are not the end all be all. You still need to know what the heck's going on in the strategy. So, unfortunately, this one is down 3%. That's still not that bad, but the other one is up 22% already. Now, this one also is more volatile. You can see here, if I go to simulated, go to, let's say, 3 years. This is another thing. It only has up to 2022, so there's not really any of the major crashes that have happened, including like the most recent one would have been probably COVID. So you can see standard deviation is extremely high compared to something like this one might be even better. Well, I guess what I could have done is click the spy here. Oh, that's right. For some reason, they don't show you on that, but you can go, I think, here. No. Sorry. Let me do this one instead. You can see here the standard deviation on SPY is only about 18% in the last 3 years. So, anyways, my whole point of this is be very careful if you guys are choosing to go on this, and this is what I said in the last video as well. Be very careful on what strategies you pick from the community. Like some of these ones might look insanely awesome, but spoiler alert, if I come over here, open this up, this is going to be the same problem as the other strategy I was showing you. There's like thousands of logic branches. Like, yeah, it's going to show great because you're overfitting. And if you can see the, and this is why the OSS date is actually very helpful, because I can come over here. OSS stands for basically when the strategy started. So up until the OSS, yes, it's still done good, but there's some strategies that this is going to suffer. So you just got to be very mindful of what you're getting yourself into, and that's why making your own strategy is obviously the best. So I'm also working on my own strategy right now. It's not just I'm not just going to do this, and this one is also not super amazing. Like it's still a little bit of complicated logic going on, but it's not thousands of different branches. Like you can see here, most of these are just checking the RSI for this stuff, and if it meets the case, it buys UVXY for like half of these branches, more than half of these branches, and then there's like a little bit of logic to buy some other stuff here. But my point is, you got to be very careful. Also, the data that it's executing on the backtest is completely different. So you also got to be careful there. And I also have some speculation that they might have some weird stuff going on in the back end with their indicators that could also cause something to be a little bit funky. But I don't want to make any allegations yet, obviously, as I'm not quite sure. I'm still working on some other stuff in the background, kind of making my own algorithmic trading bot, if you will. Because as great as Composer is, obviously there's some stuff that you can't do on it, right? Though if you code it yourself, it's going to be basically exactly how you want it. As well as with the data thing, with it being 10 minutes, I could execute a strategy within the last 30 seconds if I wanted to. Right. The only thing that I'd be worried about there would actually be getting the order filled, but you could just do a market order or something. I don't know. But last but not least, let's tally up because I think I haven't done this yet. So 260.53 it said. Just double check that. We have here, which is $13,079.46. We got the one. And $547.76. So overall for the week, we are up 4%, which is very good. That's about $486, obviously with the contribution this week as well. The market, you can see, obviously it went very green as well, but overall, not bad. I know a lot of my, a lot of my viewers are probably from the high yield dividend scene, and that's where I kind of started this channel. Unfortunately, I think, more of these outlandish or really out of the ordinary high yield dividends. I'm not talking about super high yield dividends, right? Such as Yieldmax, Roundhill, Granite shares, all of these super high yield dividends. They're just really hard to keep long term. Stuff that's more typical, such as SCHD is a little different because obviously we have several years of that performing, as well as it's not risking its capital, right? There's a very good mix there with high yield dividends such as Yieldmax. Basically, they're putting everything they can into these dividends and nothing to really support the structure and the health of the capital appreciation, aka or the price, right? So the capital appreciation basically stays the same, and in most cases that is very negative. So um anyways, I'm gonna wrap up the video. I know this is a long one, but I'm gonna hope, hopefully this doesn't just go crash the next week. I wouldn't be surprised if it did. Obviously, there's a lot of logic that goes into these strategies. Um, but I'm trying to put more time into my own algorithmic trading bot, as I said. Hopefully, I can kind of figure that out. Kind of give you guys some few pointers, if anything. Um, and I think I might do at the end of the day is use the paper trading that Alpaca Markets has, which coincidentally is actually the same platform or brokerage that basically Composer uses, which is very interesting, right? So what I want to do is test my strategy on live data, right? Not just the back test, but live data, but also not put in any money up front. So that's unfortunately something I don't see on Composer.trade that I would like to see, which is basically just a paper trading account. Because backtest can only get you so far, right? So, anyways, I digress. They might have that. I think I saw something there. But as always, guys, I wish you guys a wealthy future and take care.